Up next, legally give yourself a 50% tax savings that you never heard of. Now, if there's one thing we can't avoid, it's death and taxes, right? Well, apparently not. Unless you're a billionaire like Jeff Bezos, Warren Buffett, or Elon Musk. Now, last week, a nonprofit news group called ProRepublica released a bombshell report featuring some IRS data on some of the world's wealthiest people. Now, in it, we learned about Jeff Bezos, the billionaire CEO of Amazon, somehow managed to not pay any income tax in both 2007 and 2011. In fact, he actually claimed a $4,000 child tax credit, despite being worth $18 billion at the time. Now, the runner-up for the world's richest man, who is Elon Musk, also paid zero in income tax in 2018. It's pretty astonishing, right? Well, it might not be right, but it's perfectly legal. Basically, U.S. tax laws don't define some assets, like stocks, as taxable income unless they're actually sold. So as long as you hold on to these stocks, their wealth keeps rising, but not their tax bracket. And you can bet that wherever there's a tax deduction to be made, these guys are going to find have their accountants all over. So what can you do as a medical professional to save on your own taxes? Well, obviously most doctors or nurse practitioners probably don't have billions in stock options. Although, hey, we're not here to judge if you do. You're also unlikely to be able to apply for some of the kinds of tax deductions that Jeff Bezos can. But one thing you can deduct for under the right circumstances is insurance. That's where the power of something called the captive insurance company comes in. Now, there's plenty of information about the process online, which I would suggest you look up, but let's run through the whole theory. Ordinarily, when you pay your malpractice premiums to a traditional insurance company, that money is gone forever if you don't make any claims. Now, when you form your own captive insurance company, you collect the premiums yourself. The funds are then invested. According to IRC S831B2, the premiums your captive insurance company collects are tax-free. Your captive only pays the taxes on the income it earns from its investments. So when you do need the money, you just pay yourself a dividend. So let's clarify with an example. Let's say you're in the 50% tax bracket, and you normally pay yourself about $500,000 in premiums. You can deduct this $500,000 as an insurance expense, which gives you a $250,000 tax savings. Your captive insurance company receives the $500,000 tax-free. Now you can use that money for investments and grow your wealth. Now, it sounds more appealing than handling the $250,000 to the government, right? So what's the catch? Well, setting up a captive insurance company does require dealing with lots of regulatory compliance. So ask your accountant about setting one up. Now, if they're not familiar with this, or there are several different companies that specialize in this. So if you need some help, just text the word tax to 561-962-1231. Up next, guaranteed ways to boost patient volume.